Hello and welcome everyone to the second UK investor webinar. I have to say that I can't quite remember the first. Maybe that's the fog of COVID or some other affliction, but we are in the new normal now, and everything is online and on Zoom and all videoed up. I've been asked to come up with a few words about myself. I'm not quite sure whether that's a wise question, but I used to be a broker in the 90s, derivatives actually, futures and options, which is like the Wild West. It was like an early version of spread betting, I suppose. I was the world's worst broker because I didn't want any of my clients to lose money, so I would sort of tell them not to do stuff rather than to do stuff, which is apparently not what you're supposed to do. So the clients were rich and I was very poor. So at the end of the 90s, when the internet arrived, as I couldn't get a job as a financial journalist in the papers because I hadn't worked my way up from the Hull Gazette or whatever you're supposed to do if you're a journalist. I've got jobs on the new websites in the .com bubble. Wonderful times then for about a year, I think it was. But I cut my teeth at Shares Magazine. Initially, they very kindly gave me a job as their first technical analyst, and then wrote for people like the Investors Chronicle and Yahoo Finance and all that sort of stuff. At the same time, I suppose just in the age of Twitter, which is about 10 years ago, I started interviewing CEOs and producing other sort of content like that. And I think interviewing CEOs, I have to say, probably Gervais will know that when the small caps especially, it's basically management, just like real estate is location. So it is the case that unlike The Apprentice, after the first 5 or 10 seconds of speaking to a CEO, you normally know whether you would invest with them or not. I presume Gervais takes a bit longer to do that than me, but who knows? Maybe he will reveal that. But anyway, that's enough about me. On to the aforementioned Gervais Williams, who's head of equities at Premier Miton. Known him for quite a while and followed his way of doing things as well, and he's an intriguing man. He's written, I think, a few books. I think my favorite, I think, is The Future is Small, which I think is at the moment absolutely bang on the money. He's written about globalization as well, which is obviously part of the reason we're in the mess we're in at the moment. But at this point, I think over to Gervais.
Thanks very much for the opportunity to speak. I'm not quite sure you can hear me coming. I'm going to share screen. I'm going to talk to a few slides. It won't take too long, but I just thought it might be worth setting some context to this. And then once we have some context, then we can then talk about perhaps the portfolios and where we are at the moment. So my next presentation is called Steering a Clear Path Through Unsettled Markets. As with all presentations, we have to worry about downside. Here's a risk warning, which reminds everyone that you can lose money in absolute terms, and further risk warnings about funds which may or may not outperform. And finally, just a quick slide highlighting that I work with Martin Turner. I work as part of a team. We have a lot of teams at Premier Miton, and I work as part of a team. So to start the presentation, I thought I might just look a little bit at the underlying trends. The underlying trends, even prior to the pandemic, weren't good. This is globalization volumes, and as Zak mentioned, I wrote a book called The Retreat of Globalization about 4 years ago, and unfortunately, globalization has been in retreat, and that's going to be a challenge for us all going forward. But what you can see is it was not going well even prior to recently, but now with this setback, it's got more adverse again. And the big question is not so much about globalization, but just how much damage is the global recession going to do to corporates? Most particularly, unfortunately, a lot of companies went into the downturn with quite a lot of debt. On top of that, quite a few companies are suffering very substantial cash slowdowns and negative cash flow. A lot of the consumer businesses might go bust, and there'll be lots of bad debts. And so the fact that the stock market's been rising on an easy access to debt, it may be that trend is interrupted. Certainly, when we've seen a shortage of cash, the very immediate effect has been on dividends. This is showing a projection of dividend flows in the stock market in the next couple of years. It's from the Link Dividend Monitor. Link are an Australian company, but they do a quarterly update. And you can see how the cash flow has generated good dividend growth in the UK stock market since 2008. But unfortunately, their assessment is that dividends this year will be down between 43 and 49%. They are hopeful that HSBC and others will start to resume dividends next year. But at this stage, we don't know what other dividend cuts that may be coming. So I'm not quite as optimistic as they are. And if that isn't bad enough, we've had a pretty bad hit in terms of economic setbacks this year, but it could have been worse. Let's not forget that geopolitical events are becoming more frequent. As you get nationalistic politics, you do get more tension. And we have had a live missile exchange between the US and Iran this year. It didn't turn out badly, but it could have done. And then we would have had two crises together on just one. So for that basis, I think it's kind of useful to remember that stock markets don't just always go up. Sometimes they go sideways, sometimes they go sideways for decades. With that in mind, I think we should be asking ourselves, in the world where economies are under real pressure, why are UK microcaps interesting? And in my view, why are they in a uniquely strong position? And to answer that question, I think the first point is that they're very different from the mainstream companies. They're not part of the stock market index, of course. They're operating in different industry sectors. They're small and agile. They can grow when the world's not growing. And most particularly, their returns aren't necessarily correlated with the rest of the world. Over the last 30 years, I would argue that correlation has become more similar across most of the stock markets of the world. They tend to zig and zag together. And going forward, I think it may be useful to have assets which are less correlated. I would argue small caps are one of those. The second feature is that we probably have had an unusually smooth period of stock markets. Whenever we've had a risk of recession, the central banks have been able to quickly reach for extra quantitative easing and keep the economy going, albeit at the expense of pushing share prices up. And so we've had very few economic recessions. We had one in 2008, as you know, which was resolved with extraordinary amounts of quantitative easing, shock and awe at the time. Interest rates being cut from 5.75% to 0.5%. Going forward, we would argue that those kind of opportunities are not there. Governments are reaching for bigger budget deficits, but all that cash has to be repaid at some stage in the future. So going back to small companies, this is a bit of an old chestnut, really. People have seen this before. This is looking back to the returns from the UK stock market, different parts of the UK stock market since 1955. The all share has generated a compound return of about 6.4% per year. The mid-sized companies, which have been very strong in the last 15, 25 years, have produced a better return. But the best area of the stock market over the very long term has been what's called the Numis Small Cap Index, excluding investment companies. That's the bar, which is 9.7 written at the top. And this is obviously producing return on average a bit around 3% per year, better than the stock market overall. 3% per year compounds to a very substantial sum. Obviously, the really exciting number is the Numis Small Companies 1000. There used to be 1,000 small companies in the microcap index. There's only about 600 now. But anyway, the point is they've compounded at 11.4%. That's a full 5% better than the all-share index. And that makes a disproportionate difference, particularly when you invest in companies which are a little overlooked at valuations. They can often compound at an even higher level than that over the last 65 years. The other feature to mention is, of course, because there's a vast number, there's more quoted companies below 150 million market cap than above it. There's lots to choose from, there's lots of diversity, and from that point of view, you tend to get a smoother ride. If the market's going to get more volatile, a smooth ride in a portfolio could be helpful. On top of that, they tend to offer diversification. As I mentioned earlier, they zig and they zag at different times. And so when you've got an asset with perhaps a mainstream index fund or perhaps a mainstream ETF, then having diversification through small companies enhances the return over the long term. So with that, I just wanted to sort of talk about what happens next. And the key, from my point of view, is that with the sell-off in the markets, it was a very aggressive sell-off. It arrived very fast. And so from that point of view, what you did see was that all the jigsaw pieces were thrown into a heap. Clearly, that means there's a lot of companies which may be incorrectly priced. Some undervalued, perhaps some still overvalued. But for an active fund manager, it's been a glorious opportunity to pick up some very, very overlooked stocks at completely the wrong price. We would argue that small companies were undervalued even prior to this, and they've become more undervalued during the process. This is looking at how much cash is generated by the UK stock market in light blue compared with the US stock market in dark blue. So FTSE 100 in light blue, S&P 500 in dark blue. What you can see there is that the UK, and this is before setbacks, so it may have changed a little bit with the index profit forecast changes, but basically you can see there was a big gap which has opened up almost exactly at the time of Brexit. So prior to Brexit, people didn't mind what stock market they bought, whether they bought the UK or the US. Now they very much prefer the US, and they've been very less excited about the UK. We would argue that differential valuation will close in due course, and that will lead to the UK outperforming the US. On top of that, when you look at the valuations, this is PE ratios, looking across different parts of the stock market. You can see this is data. It's a couple of months out of date. This is it's May data. But you can see how the valuations move down as you get to smaller market caps. So the bottom end of the FTSE small cap is cheap, and the bottom end of the AIM market is very cheap too. And so it's not just a case that the smaller ones make more money over the longer term, but with all the turmoil and the jigsaw pieces, you can buy into many of these companies at what we consider to be much lower valuations. And that's particularly the case if you're not buying into a high growth stock, but a sort of ordinary company. This is a measure of companies which have a lot of assets which aren't being reflected in the share price. And so companies with lots of assets which aren't reflected in the share price at the moment are very high on this graph, which means that they're very overlooked indeed, unusually overlooked. So we would argue there's three catch-up reasons going forward. So from that point of view, we get a catch-up from the UK, a catch-up from small companies, and a catch-up from overlooked small companies themselves, which we would argue should continue to generate very attractive returns, even if indexes do flatline. The Japanese stock market has flatlined since 1989. And we probably could get into a period like we did in the 1970s and 1980s. This chart finishes in 1988. This is when globalization began, in my view. So what you see then is the light blue line, which is the index funds, produce a return. It looks like quite a good return. It made 76 times money in this 33-year period, but inflation was very high in this period. Adjusting for inflation, you made almost no money. Just like the Japanese stock market, if you adjust for inflation, you basically made no money since 1989. But you can make money in that red line. That's the small company, the Numis Small Companies Index, because they acquire assets from the receiver, make a quick cash payback on that, and generate extra cash and extra dividend growth. Big companies make acquisitions from receivers as well, but it doesn't make much difference because they're small. Small acquisitions to big companies doesn't really move the needle. And of course, that dark blue line is the microcaps. They've been compounding at around 6%, 7% more than the main market. And so the opportunity for them to make acquisitions is still there. Sometimes those deals are transformational in return, and hence you don't make 400 times your money, you make 1,100 times your money over this 33-year period. We're expecting that to happen. The UK really, the economy isn't really much different from the rest of the world, but in our view, the real difference lies in the UK stock market, which we think is radically different from the rest of the world. We're very lucky to have a vibrant universe of smaller microcaps. We're going to hear from Oisín and Naheed shortly as to some of the businesses which you can look at for your own portfolios. There's plenty around. There's plenty of opportunity. We are quite excited. So to finish, here's a summary of the largest holdings in the UK Microcap Trust. This is a fund which is dedicated to stocks below 150 million market cap. You will see that some of the larger companies at the top there are in a position where they have already risen over 150 million market cap. But in general, what you can see is that there's a vast number of companies which have already performed quite well, but we think I've still got plenty left to go. So with that, I'm happy to finish the presentation and then move on to talking to you, Zach. Zach, you gonna...
Yeah, no, I'm here. No, it's quite. I giggled, not because you said anything funny, but because one of the stocks in your list is well, one of my top charts. So in fact, it's the #1 stock on your list. So Maybe I've ruined the surprise, but a few points there. The first one I think is just from one of the slides that you had. And I was thinking of writing an article just off my own back for no reason. You know, small caps are small caps safer than houses, and obviously safer than houses is a cliche. I mean, it doesn't actually literally mean it, but it's used as that way. But at the moment, I think that in the COVID environment, it really is the case that small caps are safer than houses. One, because of the historic return that you've shown, and also how cheap they are at the moment, but also because it's obvious in a time when people are rushing to the shops to buy toilet roll, as you know, that's the thing that that's the new gold. That the liquidity is everything, and there's almost a panic in liquidity to having cash, and the worst way of having cash around is to put 80% of it or 70% into real estate, even if it's cheap. So it really is. I mean, you really want to be in something, in an asset where you can, potentially make a lot of money if you get it right. But also, if you're, if you run out of toilet roll, you can actually get that money and spend it relatively quickly, which is obviously the stock market is perfect for that, because you can phone up your broker and get out of whatever stock, especially even the small caps things. And so that's what you've seen over recent months, a real return in liquidity to the small cap area. And my question is, would you agree that small caps are booming at the moment? There's a massive interest, massive liquidity, and it's a bit like the time I mentioned before. It's like the dot-com bubble in terms of just the general interest and the gains. I mean, obviously the pharma stocks have gone through the roof, as there's different sectors, and so it's become what was previously regarded as really risky has become the thing to be in. And do you think that's going to progress?
Yes, I mean, I'm excited by the opportunities in small caps, but I probably would be much more cautious about risk. First of all, safe as houses, as you say, isn't always as safe as houses. There's an awful lot of debt, and some people in the audience may remember negative equity. So you can lose all your equity and be standing on a loss-making asset. So let's not downplay risk. And quoted companies, some do fail. Even some very successful companies, for factors which are completely beyond their own control, fail. So you can lose all your money in these companies. So let's not overlook risk. But the whole point about risk is you get a return associated with risk, and particularly if you select well, you get a premium return versus that risk. And I would argue that small quoted companies are unusually overlooked. I think the risks are very highlighted in people's minds, not just with the Woodford gating. She was invested in unquoted companies, not quoted companies, but the quoted companies seem to suffer. But also generally because most investors have been very focused on the index and fast-growing companies and momentum stocks and all these other things. And we've got lots of companies down here which are relatively small relative to Shell and Nestle and some of the biggest companies, but are still major international companies with major teams of staff operating on the international stage, and sometimes with world market positions. And I think that's a great combination. And I just think of, say, a company today which has just reported, a company called Kenmare. Kenmare is a resource company. It picks out ilmenite from the coast of Mozambique. But it's put $1.5 billion to work in its mine over the last 15 years. And yet its market cap in dollar terms anyway is still only 316 million market cap. So it's just 1/5 of the cash they put in. And over the next couple of years, they're moving from a 3% yield, according to the profit forecasts, which may or may not be succeed, but to a 6.8% yield, to a 9.1% yield. That's a gimme if it's right. And so there's just plenty of companies to choose out there to get involved in. But I would always argue, follow the cash. Don't follow the share price. Don't follow the momentum. Get involved in companies which are investing hard for cash payback. And it's that cash payback which is going to drive ultimately the share prices going forward.
Right, I've got a couple of questions from the audience. The first one, hopefully a simple one. Does the market cap have to be below 150 million to qualify as a small company?
I mean, this is a microcap trust, so I suppose you might argue that microcaps are below 150 million market cap. The fund itself doesn't have a limit. So if I meet a company at 151 and there's no kind of automatic cut-off, oh dear, I can't buy it. I can't buy it for my clients. If you get a company which is 100 million at one stage and then goes to 200 million and does the most amazing acquisition, where they're issuing shares for half price, which are going to double tomorrow when they're issued, am I allowed to buy more shares for my clients? Yes, I am. So there's no hard limit to the 150, but most of the holdings in the portfolio are below 150 million market cap, because those are the most overlooked by institutions. Those are often some of the most undervalued. And when they come right, often those are the ones which rise the most. So that's the focus of the fund.
Right, now the perfect question, if you want to talk for the next 3 hours. What do you look for in the type of stocks you showed?
So the key issue we're always looking for, and I touched on it a little bit earlier, was if we are putting our clients' cash to work, tell us about how you're going to generate a cash payback. It's all about cash payback on investment. So we're very, very focused on cash and more cash going forward. And if we can dilute risk by investing in companies with safe balance sheets, so that if it doesn't happen quite on target and is a little bit late, then you don't have emergency fundraisings and dilutions and all that kind of thing. That's the thing. So we've just focused really hard on cash payback. And let's be honest, we're not even very tolerant about cash paybacks in 5 and 7 years, although that's fine if you're a utility or some parts of the market out there. Let's just see what's happened in the last 3 or 4 years. We had Brexit about 4 years ago. We've had Trump and all the engagement on sort of deglobalization as a result of that. We've had the pandemic. It's hard to look forward 3 or 4 years with any degree of confidence. So we tend to invest in companies which have much quicker cash paybacks, often 3 years, sometimes even shorter than that. One portfolio holding we had is a company called Venture Trust. It's a company which is involved in mouthwashes and selling them to the Chinese, and it can't sell them fast enough. What has also happened, it has a factory in northern Italy, and when the lockdown arrived, it continued to work, partly because it used some of its plant to make hand gel for the hospitals, free of charge to start with. But they got so much demand, they actually bought a new machine, and they brought that into production in May, and the cash payback on that machine was 1 week. That is a very exceptional cash payback. There are almost no businesses, and it probably didn't cost an awful lot, that machine, but we love that kind of thing.
Yes, I know the company. It is. I can see that it's a fund manager's delight in that kind of way. It's very sort of simple, non-blue sky type of business. The question that I think I've obviously watched you many times and given many presentations, and we've sort of done this double act before. But I think the one thing you've never said, maybe you're not allowed to say it, I don't know, but it's just, if I'm sitting here thinking, I've had a punt in a few small caps, it hasn't gone very well. I'd like somebody else to take the strain. How do they go about it? How do they go about investing with you, and how much do they invest? Is it 1% of their net worth, or is it what? That's something that I think I haven't heard you address. I'm not, as I said, I'm not sure how what your answer is going to be. But if you don't want to answer it, obviously tell me.
Well, obviously, I tend to hold back on that kind of answer because a lot of the people listening will be people who do invest directly. And in a way, I'm thrilled by that because they improve liquidity. It's all very well having an institution like me involved in some of the companies which are in the portfolio, but I don't trade very much. I don't add to liquidity. In fact, if anything, often I sit still and do nothing at all. And so we need private individuals sometimes to trade across figures, sometimes to trade just because they've read something in the newspaper, sometimes because they're just doing a kind of cluster and they're buying all of the companies in the healthcare sector. Whatever it is, different people with different perceptions add to market liquidity. And market liquidity is the cornerstone of all exchanges. The AIM exchange, the London Stock Exchange. Exchange is in the name. Liquidity is everything. And liquidity has been a little bit unsettled, partly because commission's gone down, partly because institutions are concentrated on the largest companies. But going forward, liquidity has definitely improved. I think you brought that up in your introduction. I think the interest at the bottom end is increasing. We're seeing the microcap in the UK increasing. There is some small companies listed in the US, not so many, and they tend to be much more speculative over there. But even there, the Russell Microcap Trust has started to outperform recently, and that's bringing more liquidity. And the great advantage for private investors is if you're investing, 25 £5,000 or £50,000 in each unit, then you don't need to worry too much about liquidity. You can always buy, you can always sell within reason quite quickly. Institutions, if you're selling in, if you're investing 250 million or £1 million in each unit, of course, that becomes more problematic. But coming back to the question, yes, I mean, I'm very delighted with people who do buy our funds, and you do it through a stockbroker, if you want to buy investment trust, or through one of your platform companies if you want to buy a unit trust. But I don't push that, because ultimately, a lot of investors we're talking to are investing in their own stocks, and I'm delighted when they do that too.
So it's a sort of, so it's like a community effort. I mean, they're helping you, and you're maybe helping them when you get into their stocks, etc., etc. So it's sort of working like that, rather than you trying to get as much under management as possible. Let's say it's more the performance that you have rather than anything else.
Yes, and quite honestly, you know, small companies are small, which means that my funds will never be challenging some of the biggest fund managers in the city. You know, I will have to stop people buying my funds eventually if they buy too much, because they're, you know, we have liquidity constraints ourselves. So from that point of view, I'm delighted that, you know, clients are in there, and I've got lots of clients who have ordinary shares and they buy some of my funds too. But ultimately, the key issue is that there's that range of interest, and it's that infrastructure of supporting companies, that infrastructure of investors, which ultimately differentiates the UK from the stock market from the other world. As I say, the UK economy is no better than anyone else. The UK stock market is radically different from most others, and in my view, as we saw in the 70s, we will find in due course some small companies will have performed by an absolute mile, and most institutions will have to start moving down the market cap range and participating, and they'll get a virtuous spiral, and the sector will continue to outperform possibly for a decade or two.
Right, just there's one question here which I think we'll close on, because it's quite a decent one, I suppose. You've got Caledonia Mining in the portfolio, and mentioned Kenmare as well. Both Zimbabwe and Mozambique have problems. What about other AIM companies in the resource sector, especially gold and silver? If one doesn't like those particular geographies, let's say.
Yeah, I mean, you know, as I mentioned earlier, you know, all companies carry risk. Investing in Zimbabwe or in Mozambique definitely carries risk. Those companies investing in Mali, and some of the gold mining companies in Mali, have come down quite sharply in the last couple of days with the coup we've seen there. The main thing about a portfolio is to try and limit the amount of you've got exposed to one particular risk. So we do have Caledonia Mining. It is invested in Zimbabwe. The share price has gone up 5 or 6-fold since we invested, partly because people have been terrified that the asset's going to be nicked. When I was speaking to the company, even actually just a couple of days ago, they said that from their point of view, the support from the government is overwhelming, because it's not so much that they couldn't nick the rest of the business, but they want inward investment more than anything else. And if they nick cash from Caledonia Mining, they can say goodbye to any inward investment. So there are times when risks are perceived to be very high, but actually the behavior of the local country is actually much less risky than most people think. And it's that mismatch of risk which can often lead to substantial return. So I certainly don't say, don't put more than one investment in Mozambique, don't put more than one investment in Zimbabwe, don't put more than one in Mali. So have some resource companies, have some oil companies, but put them in other sectors and other factors, so that the overall aggregated risk of the portfolio is moderated. When you see the underlying volatility of some of my portfolios and some of the other portfolios around, you find actually the aggregate risk is massively diluted by that diversification. So have a look at these things. Definitely have your eyes wide open. Be prepared, unfortunately, to lose everything, because that's always the risk. But often, if there's a mismatch between the risk perception and the risk in actuality behavior, you can make a very handsome return, as we have with both of those companies so far.
Gervais, I think that's a good place to end on. Thank you very much. I had a question. Somebody wanted to see your list back up. It almost sounded as if they'd rather see the list rather than you, but I don't think that's the way they meant it. I also presume they'll be able to see that on the recording. Obviously, well, they can see it now. So so if they want to get the mobile phone out and try and copy it, I'm sure they can do that. A very interesting list, and I suppose that the main thing there is just you've got so many different companies and so many totally diverse areas, which says it all, really, doesn't it?
And there's over 100 holdings there in that portfolio. and it hasn't stopped performing. In other words, you know, some people think if you've got very small holdings, you never make enough money, but if you get the risk-reward ratio, which comes right in a number of cases, you can make attractive returns.
Okay, thank you very much, Gervais. Hopefully we'll do this again sometime. It's obviously slightly easier than shuffling off to some event somewhere, some physical event. So this is seems to be quite enjoyable. Thank you very much indeed.
Thank you very much.
Okay, next up, I've got the man that, I didn't actually, I was so excited at the beginning of this that I forgot that there were two companies presenting after Gervais. And the first one is San Leon Energy, in the form of Oisín Fanning, who's the CEO there. San Leon, for those who do not know, is a progressive independent oil and gas company whose key asset is OML 18 onshore Nigeria. They're committed to a strategy of securing production and near-term operating cash flow in Africa and yielding value to shareholders. And on that note, they have managed to return more than $60 million to shareholders via dividends and share buybacks over the past year. And the point, I think, which has impressed me the most and maybe holds the record in terms of director buying that I've ever known is that Oisín very recently bought £20 million worth of shares in San Leon Energy, which I thought was amazing, particularly as I'm trying to work out where he got the £20 million in the first place. But I'm sure he'll tell us about that too. But just, I mean, obviously, as a green flag, that is pretty impressive, putting your money where your mouth is. But I will let Oisín tell us about his company and where it's going over the near term.
Sure. Good afternoon. Thank you, everybody, for taking the time to join us. I'm just going to try and move to my slides now. The first thing I'd like to say, looking at Gervais' list and looking at his comments, is that I'm actually delighted that we took the bold step in basically October 2016 to tell the market that as a name stock, we were going to give back at least 50% of net cash to shareholders, which we've certainly been doing over the last couple of years. So hopefully, Gervais, if you're still listening, we might see ourselves on that list in the coming weeks or months. But let me just change the slide here. Sorry. Just one second. There we go. Thank you. So look, the most important thing from a San Leon point of view was back in October 2016, and we made an investment, as you say, in OML 18 or Eraton. That investment was a loan of $175 million at a coupon of 17%. And for that, we also got 10.58 indirect interest in the field itself, which fundamentally meant that the field was effectively given to us for free, for want of a better word, because I think the 17% coupon was probably enough to get on any loan. To date, we have received 200 million back on that loan. We've returned 66 million to shareholders in the last 2 years. We did a recent coupon dividend, special dividend, but it had a coupon of 30% in these hard times, which is no mean feat, particularly for a name stock. And we have a further at least 100 to 110 million due back to us in the next 15 months. And we'll certainly give at least 50 to 60% of that back to shareholders. That's a stated aim of the company from day one. So we're certainly right smack bang in the middle of that sweet spot that Gervais was telling you about, a company that has good cash flows, that's returning cash, and then, as we'll talk about later, making investments while protecting the cash that we're investing at the same time. So you mentioned that I bought 21.8% of the company. I did. And my bankers were quite happy to fund that. And the reason for that is that they're very happy that the returns are going to happen. If you look at the dividends alone, as a 25% shareholder of the company overall, the dividends alone are just on their very own will pay at least back my loans plus interest in the coming 2 years. So it's a very comfortable position to be in. And that's because I serve on the board of Eraton. I am the head of the finance committee in Eraton in Lagos. And so I see everything. So clearly, and the only message I can give is that I'm comfortable with what I'm seeing, and I was comfortable to make that investment. So in terms of OML 18, I actually show this mainly because of the size. It's huge. It's a huge field. It was founded in 1958, developed in 1970s. we're producing between 45 and 50,000 barrels a day currently. Now, we're losing nearly half of that to bad infrastructure, to theft, etc., which is, of course, very irritating. But we're addressing that, and we've invested in a new pipeline ourselves, which, again, I'll talk about in a further slide. So those losses will disappear in the coming 2 or 3 months as soon as that pipeline goes live, and that's very, very key. But this field is very important to say, too, used to do 180,000 barrels a day. So currently it's doing 40 to 50,000, but certainly looking forward to the next 2.5 years, there's absolutely no reason why it won't do at least 100,000 plus. You know, this field consists of many existing fields which have multi-stack pays, and the major who used to have this field often only tested one. And we can go back in and test another 3 or 4 stacks and produce more oil. And so that's very key. At the moment, we go, as you can see, to the Bonny terminal, but that will change in the coming months. We are building a pipeline which runs 50 kilometers out to sea. It runs straight down a very clean, pristine river where there are patrol boats that go up and down. So it's not through a swamp, as we currently do. And then it goes out to an FPSO, and from there on, it gets taken by Shell. I'm going to move to the next slide. So in terms of improving the output on OML 18, it has to be said, the last few years have been easy wins for us, because the majority of the time, Shell, used to own this field, had a lot of problem with vandalism. And that vandalism meant that, you know, fishermen going by would hit a valve, would throw something down the well. No sooner would Shell go out and repair it, they do the same thing again. And there was an ongoing issue with the locals. And what my partner did in Ereton was he went and hired 600 local people. They formed 6 separate companies. And for want of a better word, poachers turned gamekeeper, they are now the security. And since that day, since 2016, there has hardly been a single act of vandalism on the field. So it's been quite easy to go from the 10 to sort of 40, 50,000 barrels. But now we're actually drilling wells. So we drilled 3 wells in the last year. The first well produced, I think, 4,500, 4,800 barrels a day, and continues to do so. The second well was aiming for about 2.5, is doing about 1.5 at the moment, but we have plans to upgrade that. And the third well, to be quite honest, because of COVID and a few other things, really hasn't been put on test yet. We're going to test it directly into the pipeline, and we'll see what happens in the coming months. The plan was to drill another 11 wells. That slowed down a bit, obviously, because of the price of oil. Our oil currently is hedged at $55 a barrel for the next 18 months. Well, 15 months now, 3 months have gone by. So we're very fortunate in having that. But certainly the price of oil doesn't validate drilling another 11 wells. So I suppose if you look forward to next year, you might see another 3 or 4, unless the price of oil starts moving up past 50 towards 60. So the other thing worth mentioning is we have a prominent position in Nigeria. Salion Energy live and breathes Nigeria. We're there. I spend a week to 10 days there every month. So do my colleagues. We have our own apartment there. We have our own offices there. So we're not absentee landlords. We're there all the time. We know who the local people are. We know how to play the local politics. And that's very, very important, because there's a marginal field round about to happen. And we're part of that round, but we think a lot of people will be successful, a lot of locals will be successful, and they will look to people like us to provide finance. So we have a hit list of the fields that we like, and we're going to sit back and going to wait and see who comes to us and what type of financing they need and what type of percentage we'll get for our money. And that's very, very key, because that's the first marginal field round in a long, long time. And you must remember, marginal fields in Nigeria, that's 100 million plus barrels. Effectively, they're anywhere else to be regarded as decent sized fields. On this slide, look, I mentioned our commitment to return 50% free cash to shareholders. That stands. We'll be doing at least that every single year. So in terms of corporate developments and where some of this cash will come from over the next couple of slides, OML 18 is now renewed for the next 20 years. We were the first company in Nigeria to have that renewal put in place last year. So we have at least another 20 years, and that's very key. We renegotiated the RBL. That's given us an extra 100 million of cash a year by doing that renegotiation and moving to another bank. We did make an investment very, very recently in the new pipeline. So we've invested, as you can see, $15 million at 14%. We've received 10% equity in the field, in the pipeline itself. And that pipeline is going to do a minimum of between 80 and 100,000 barrels a day. Look at the charge on that at $5 a barrel. when it's fully operational, that'll be 500,000 a day. Sanyon has 10% of that effectively. Obviously, there are costs, but the costs are quite low. And again, we've appointed one of our directors, Joe Price, as the director of that company as well. So we're going to be, again, at the coalface, seeing exactly what's happening, etc. But I think having this type of infrastructure is good for Sanyon. It makes an awful lot of sense. And in terms of future deals, there are other deals like this pipeline deal that we did, where we guaranteed our money back no matter what. We lend our money at a coupon and get a percentage of any upside that there is. And I hope that we'll be able to bring one or two more of those to the market in the coming months. But we're working very hard at it. There's no guarantee, of course. In terms of, this is just a slide which just shows you the extent of OMA 18. I mean, look, it's the size of Bahrain. It's huge. Processing plants. It's a massive undertaking. So, and it continues to be built all the time. It's fundamentally on swamp at this moment in time, and that's been one of the difficulties in terms of the pipeline, because it's hidden 9 meters below the swamp. And in fairness, when people steal from it, they're quite creative. I mean, back in the day, Shell would tell you the story where they were flying over the field and they saw a whole load of Shell employees working diligently in the middle of the field, and it turns out it was oil thieves with Shell uniforms. So, the fact that all those locals are now our security is very, very key. We've had no theft, really. There's no vandalism, I should say, in the last, 2 years? So that's been key. So in terms of our development plan, it's, as I said, light workovers to increase and reduce, because, there's a decline in any oil field. I think it would be fair to say that the surface fixes and light workovers, etc., that'll solve that decline issue. So on average, a field will lose 15 to 20% per annum. We'll solve it with that. But the main key issue is going to be the wells that we're currently waiting to test, one, and at least another 3 or 4 that we're going to drill. And if we can produce, 4,800, 5,000, and sometimes 8 or 10,000 barrels a day, that's very, very key. And these wells are not difficult wells. I mean, we know the oil is there. It's akin to shooting fish in the barrel. I think the success rate to date, 3 out of 3, isn't bad. So, in terms of the community, Sanyon does invest in local communities, not local to our oil field, mind you, in fact, very much towards the north of the country, but we have built a school, we have built a hospital, and we've built a small factory for the local ladies who do a lot of sewing, etc. So, we do reinvest in Nigeria itself, and not to get a natural benefit, because our main partner, Eraton, invests substantially in the local community as it is. So we decided to go further afield and source out a community that really needed some help, and we've done that. And that's very, very key to our policy of engaging with locals. This is the pipeline. You can see where it's going. It's running down this river and then going 50 kilometers out to sea to the FSO. We own 10% of that pipeline now, and we expect that to be operational certainly in the coming months. That's going to increase our revenue stream, I mean, as in Eraton's revenue stream, by at least 40%. I mean, that's very key. So while not even drilling a single well, by just laying this pipeline and avoiding the creaking NCTL pipeline, by avoiding the tests that are included in that, we end up with 35 to 40% increase in revenue stream. And that's just very, very valuable to us, as you might imagine. Move forward. And in terms of generation of cash, where's the cash coming from? I mentioned at the beginning that under the loan notes, there's at least $110 million coming back over the next 15 months. In terms of rig-based services, for our advice on where to drill and what to do, we get $1 million a well. So last year with 3 wells, we invoiced $3 million. And no matter how many, that is a contract that we now have with Eraton. So we would get $1 million for every single well drilled for our technical input. And in terms of dividends, then obviously we have our 10.58% of the field. That's very, very key. So we'll be getting dividends from that. So therefore, that 40% increase in revenue stream is very, very key to us. And the only other point, we have a net profit interest in Barry Rowe, but like everybody, we sit back and we wait for somebody to drill that field, etc. And the other revenue stream that we've now done, and we only closed the deal recently, is the ENI, the pipeline. I mean, the pipeline is going to produce somewhere between $8 and $10 million a year for us. I mean, that's $5 million going back to shareholders, whatever way you look at it. And that's very, very key. So, and it's, the interesting thing about the pipeline is that cash is guaranteed, because Eraton itself has to book its own time on that pipeline because it's independent of Eraton. other like OMA 24, other fields in the area would also like to use it, but they must book and pay in advance. So you know, the nice thing about a pipeline business, it reminds me of a toll road. You know, you've got to pay. It's that simple, and you've got to pay in advance, in fact. So even before you use the toll, very, very key. So it's a blue chip investment. We're very happy with it, and we're looking at one or two more investments like it. So in terms of numbers, our market cap at the moment is 125 million. We have returned $66 million to shareholders over the last 2 years. Last year, we did a share buyback at a 50% premium to the share price. That was at 46p at the time. We returned another 30-odd million to shareholders very recently in terms of a special dividend. And we're going to continue to do that. And that's very, very key, I think, for investors to know. It's a rarity on AIM. I think an oil and gas company is actually returning real cash to shareholders, and particularly in these very difficult times. We're due 100 million plus on loan notes. We have a 10.58% of the field indirect interest, yes, but we will get our dividends from that. Our current production is going to move up towards 100,000 barrels. But when we say current production, once the pipeline is real, is operational, that's real 50,000 barrels a day. At this moment in time, 50,000 barrels like 25, 30,000 barrels. And that's very, very key. In terms of gas reserves, we have a huge amount of gas potential. Our partner also has a chemical plant right beside us. So he's 560 hectares where he has a urea plant. We currently sell 60 to 70 million cubic feet of gas a day to that plant. But he's now going to be building an ammonia plant, another urea plant. He's got free port status there. He's one of 3 independent ports in Nigeria. And with that free port status, there's going to be huge demand for more gas. So we're looking gas sales there in the region of 200 to 400 million scuffs a day within the next 2 to 3 years. Again, good additional revenue stream. And the rest really I've spoken about, so there's no point in repeating myself. But what I do see, and one of the reasons why I did invest myself, is that I do see that this is only going to improve for Sandeon. We spent a long time working hard at it. It's taken a number of years. People were worried they wouldn't see the money coming back out. They're seeing it straight into their pockets, and that will continue. So this is the usual disclaimers that Gervais spoke about at the beginning, and I just want to say thank you, and I look forward to your questions.
Mm-hmm. Yeah, I'll start the questions myself. I think that there's a number of issues or things which can be discussed with Sandeon. One is that you are on AIM, and you are very unusual for AIM in terms of being basically a cash machine, let's say. Do you think that you would be doing yourself a favor if you were on the main board?
Yeah, that's a realistic possibility. There's no doubt about it. But I'd like to see. I mean, there's one thing which is fair to say is that when I looked at when I addressed that a question before, I was looking at the fact that AIM is very easy to raise funds on compared to the main board. You don't have to do the full prospectus. You can just go straight to investors and say, look, we need some funds for X, Y, and Z. That's slightly changed now because we're long on cash ourselves. We'll be keeping at least 40% of the cash that we're generating. So it would be fair to say that it's something we're looking at. But I think we're only starting to over the last 2 years to show what we can give back to shareholders, and I think we'll continue to do that for a short time yet. And maybe certainly, if you ask me, in the next 2 years, we certainly see ourselves on a different board, shall we say? Right.
And the other point is, I think that when a company is undervalued or unloved, which maybe one could say that Sandeon is, and maybe because of the Nigeria factor, or because of the oil price factor, or whatever factor, the levers are direct to share buying, which you've done, and then obviously share buybacks, which you are doing. Is it? I mean, do you think that people have the message in terms of what that Sandeon is? Don't look the gift horse in the mouth type thing.
Yeah, I believe they are. I mean, look, we've seen a steady rise in the share price over the last while, but steady, and it's gone from say 100 million to 124 million after dividends, etc. I think people are beginning to realise it. I think We have a good shareholder base. Tosca Fund has 51%. I've got 24%. Our partners in Nigeria have 13% of the company. So it's a very solid shareholder base there. So and we have a very clear stated dividend policy. So I think people are beginning to see that and realize, look, you know, and I speak locally, at least there's some sort of a hedge. I'm going to be seeing some money back no matter what. And money does come out of Nigeria. There's never really been an issue with money coming out of Nigeria for anybody, to be honest. Even in the days when they had coups, etc., the oil business was never affected, because without that revenue, they have no country. They desperately need to see that oil revenue. It's dollar-based, and there are no exchange controls. I think the interesting point for Sanion was, you know, we had a lot of proving to do, and that's being honest. We started out as a shale gas company. We got involved in Poland and other places in Europe. We actually found gas and then discovered, quite frankly, that the cost of extracting that gas from shale gas terms was just prohibitive. $35 million to do a 1,500-meter horizontal compared to like 5 in the States. And we had to reinvent ourselves. And very fortunately, you know, when we looked at this particular asset, and I knew this, my partner, GT Ocoloco, for 2 years prior to doing any business with them, we got very lucky in that a number of funds, particularly Tosca, decided to invest in us and help us move from a 20 million market cap company to effectively make this investment of 175 million. And so, you know, people sat back and waited. They thought, okay, they'll never get the money out. They'll never get the returns. We have, and we've shown that. And we've also shown that we've honored our word and returned funds to shareholders, and we'll continue to do so for very good reason, by the way, because I need those myself to repay my debt.
I think I mean, I've interviewed you a couple of times before. I mean, that point there about which point I like actually is that let's say Nigeria is seen as a geopolitical hotbed, etc. But you said there that even the most warmongering, bellicose citizen of that country, if they were staging a coup and doing this and doing that, they would still leave the oil and the oil pipelines alone, because they wouldn't want to shoot themselves in the foot. And so whether it was a dictator, no self-respecting dictator, tyrant, or general nutcase would do that. So basically, that myth, it's almost like a myth, really. It's a misconception, really.
I 100% agree. It has been a myth, because in long time ago, there were a number of coups in Nigeria, but I mean, the oil and gas business was never affected. On the contrary, without it, they can't survive.
Right. So they go to secure it immediately. As soon as they've taken over the presidential palace, they make sure that the oil field's okay.
Yeah, but look, I think the biggest problem in Nigeria was corruption. You know, over the last decade was corruption, wholesale corruption at a very large scale. And I think Buhari, who is now in his second term, addressed that dramatically in his first 4 years. And so therefore, Africa's Africa. There'll always be corruption, but that wholesale corruption that existed is gone. And he's been very aggressive in stamping that out, and continues to be. So I think people are feeling much more comfortable in terms of doing business, as do we. But the most important thing of all is get to know who you're doing business with. You have to spend a lot of time in the country and get to know the people. They have to know that you're there. If you're an absentee landlord popping in and out every now and again, you know, they've no interest. And you know, we took a very decisive view long time ago to actually get an apartment and spend time there. There's always one or two of us there every single month, every single day of the month. Now, virus accepted, because over the last few months it's been shut down. Yeah. But in general, we're always there.
Okay, I'll just a question here. Well, sort of a double question just to finish off. Is the government there taking generous taxes off you?
No, at the moment we've had quite a bit of exemption from taxes. They take their royalties, etc. But I mean, no more so than any other country. It's what the government have done, though. There's no doubt about it. They've been very quick to make sure they get paid their taxes, because it would have been fairly standard in Nigeria. If you got your royalty bill for 50 million today, you probably wouldn't pay it for the next year and a half. You'd pay it in little bits and pieces. Now the government is very keen, because they need it for their own budget, to demand that oil companies pay on time, with the threat of losing their license. And that's very key. And so therefore, our partners have been very much on top of that.
The other question, much of the success of your business is dependent on the effective functioning of the pipeline, but long-run pipelines through difficult territory are notoriously difficult to defend. Is this a significant risk to the business?
On the contrary, it's the opposite to that. It's not a risk. What is a risk would have been to stick with the NCTL pipeline, which is creaking at the borders all over the place, as in leaking. There's a lot of theft in that, and you can't see it because it's running through a swamp. And trust me, these guys can go down 9 meters deep, connect up, and run a pipeline 3 kilometers away to the makeshift diesel factories, and you can't even see it. Long gone is the day when you saw an oil slick where they connected in and you could go and get rid of it straight away. No, this pipeline runs straight down a river. There are many pipelines already there. They never have been touched ever in the particular river, and then 50K out to sea. So it's actually a pipeline that's not going to leak. The only thing we'd be worried about is downtime, which might be 3% just for maintenance, etc. So I think I mean, our revenues are going to increase by 40%. We get on extremely well with the locals. As I said, we employ 600 of them as security. I see no risk. It's a win-win, and it was a very good decision of our partners to get somebody to build that pipeline and agree to fund it.
On that note, Oisín Fanning, CEO at Sanlion, thank you very much for presenting to us and answering questions and clearing up a few myths. I think there's quite a few myths to still to clear up in terms of investor perception, but that's the point of these webinars. So thank you very much for that.
Thank you.
Okay, the next company is hopefully waiting in the wings at the moment. It comes in the form of Oracle Power, and the CEO there, Naheed Memon, will be introducing her company. Oracle Power, for those who do not know, is an international power and natural resource project developer listed on London's AIM market. It's currently focused on delivering reliable and affordable power in emerging and developing markets. Over to you, Naheed.
Hi, good evening, everyone. Thank you, Zach. Thank you for giving me this opportunity to take you through the company and sort of share the current status and what we're planning to do going forward. I'll share my screen here so that we can put the slides up, and hopefully, yeah. All right, so I've just taken the corporate presentation that we normally we put up on the website, and so that I can have that as a reference, and we can talk about where we are today and what we're looking at. So as Gervais was saying, we are, we fit right into the sort of undervalued and an opportunity stock right now, because we're sitting on a very valuable resource, and whilst we're in the midst of developing it, we are, okay. I'm just thinking, why is this not, yeah, okay, sorry, that's the standard disclaimer. Right. So whilst we are developing it, I think, have not only this opportunity, but also a number of different opportunities have opened up, and we're looking at a few other things as well, which I'll talk to you about. But before I do that, I want to run you through our main resource. So currently, our key resource is a lignite coal field in Pakistan, in Sindh. The story of Pakistan is really important and really interesting, especially in the current climate. 200+ million people. Pakistan is a part of the One Belt, One Road global strategic program. So all the investments being made in Pakistan right now, all the big investments in infrastructure and energy, in oil and gas, even in agriculture now, are under CPEC, which is the Chinese-Pakistan Economic Corridor. So our project fits right into that. It's a priority project, and so that is a big part of our resource as well, because that gives us access to debt to actually be able to undertake projects in billions of dollars, and which is what we are looking at currently right now as a company. So that's our main project, but our strategy is really focused on unlocking the value of underutilized and underdeveloped natural resources, and thar coal and lignite being the key resource that we currently hold. We're also looking out for other opportunities, which are sort of potentially quicker turnaround projects in the emerging markets. So we just signed an MOU with our main shareholder, a major shareholder, to develop projects in Africa, and specifically this iron ore asset in Guinea. At the same time, we're also looking at other opportunities which come our way based on the team that we have, based on our position, our financial position, and the sort of the experience that we have now got backing such developments. We have spent some money in Pakistan already on this project, close to $20 million, 18.4 million pounds precisely. Currently, we have enough cash to sort of take care of all our working capital requirements, and we are also able to access more finance if needed through the financing facility that we've signed on, which I can share with you a bit later. So just to run you through the main asset that we have, which is very valuable based on the uses of this asset right now. It's 30-year lease. Thar coal, the entire Thar coal fields is the third largest lignite field in the world, and it has 175 billion tons of coal. The main purpose that is sort of identified and is viable commercially and tested is thermal power generation for this lignite. But now there is a plan, a proposal, as well as a commercial agreement in place now between China and Pakistan to use this coal for coal chemistry. So use it for gas, for urea, as well as for liquid production. Our project, we are looking at developing our mine, which is 66 square kilometers, as I said, and building a 1320 megawatt power plant, a mine mouth power plant. And the second phase of our project would be to set up a urea plant, so do coal gasification for urea, and also look at liquid technology going forwad. Our development partners for this project are the Office of His Highness Sheikh Ahmed Dalmouk of the UAE. He's a member of the royal family there, and our main technical and financial sponsor for the project in Pakistan is China National Coal Group Corporation, which was China's ex-Ministry of Coal. So they bring with them an incredible expertise in developing coal for all purposes. And they have typically developed coal as a national asset. So it's for power, it's for gas, it's for liquid, for trade, etc. So that's how this entire development of this mine is envisaged, and that's the journey we're on right now. Just to share where we are really, so that's Pakistan, and you can see that in the right-hand corner, that's the province of Sindh, and right at the bottom of that, the southern tip of that at the bottom is the Thar Desert, which borders with the Rajasthan Desert in India, and so this is just this massive reservoir of coal. And our block is the white bit there. If you can see, that's block 6, and I specifically point this out because the block right next to us is block 2, and that's where power has already been commissioned. It's online. So 660 megawatts of power from this very coal now is already online. And going forward, the government of Pakistan has decided to increase the proportion of Thar coal in the energy mix. So which means that right now it's just currently 2%, but going to 2030 is expected to be 10%, and and they are increasing the reliance on local coal as a base load fuel. Although they want to increase renewable energy, but that's intermittent, and Pakistan is in a bit of a trap when it comes to its ability to sort of import fuel because of its liquidity and its current account status. So hence there is an increasing emphasis now on developing this coal for all purposes. The expenditure, as I said, is in excess of $20 million. The project cost that we estimate now, the entire project, which is going to be in phases, primarily the first phase being the power plant, so developing the mine for the power plant, and then the second phase of it would be for the coal gas for urea. So together, we would be looking at approximately $6 to $8 billion. Now, the reason that this is possible is because of CPEC, and there would be Chinese funding. The debt would be covered through that that program, and typically that's the only way we could fund a project like this. Although there is a sovereign buyback, I mean, the power is purchased by the government, but nevertheless, it's very hard to bring in other investors to develop, coal mine in the current scenario. And so that's what the country has realized. The government realizes that CPEC is its opportunity to develop this asset. In terms of the returns that we're looking at, the dollar-based for just the coal, 16 to 18%. For the power, it could be between 15 to 18%. And the reason I cannot tell you exactly what the return would be is because these are tariffs which are awarded once a petition is filed, and we are in the process of securing commissions to move forward in that direction. How does Oracle plan to participate in this big project development? Well, right now we plan to hold around 12% of this entire project, and the equity for that would partly be adjusted against the historical cost that we have already incurred, and then of course we would also be able to get some money through some loans and through some equity financing and so on. So we'll have to construct a structure to partake and to maintain our share of 12%, but of course the equity drawdowns would be over a period of 3 to 4 years. The province of Sindh is where the city of Karachi is. That's like the biggest commercial city in Pakistan, the capital, and this desert is around 380 kilometers from there. So our resource is confirmed, a JORC resource of 529 million tons in phase 1 and phase 2. Our feasibility is par excellence, and in fact the other blocks have also taken a lot from it, and we value this as a big part of what we've actually already developed and done. As I already said to you, that block 2 is already there. It's got the power online, so that's proven now, and that helps to mitigate our risk greatly. CPEC, as I already mentioned, is a big part of our planning viability. So block 6, that is where our project is, and that's the block that we have a lease for, is a priority project in CPEC. So the way CPEC is programmed is that projects are introduced, some are actively promoted. Priority is right at the top of the merit order, meaning that these are the first ones to now be pushed out. So we still sit in priority, meaning it remains a priority for both the governments to facilitate the project. CPEC is a government-to-government engagement, and that's why projects like this take a bit longer to actually get rolled out, because these are cabinet decisions that are taken in order for support to be harnessed and for the Chinese banks to then lend to a project like this. We're also in CPEC for another working group, meaning another part of CPEC's program, and which is the oil and gas sector. So we're already also in that to develop the coal to urea plant. I'd also like to point out the sort of the rationale and why this is so valuable, this inclusion in the oil and gas, is because Pakistan's gas reserves are declining. By 2025, they'll be 50% of what they are today, which sort of makes the commercial viability of the gas for urea very, very high and very attractive for investors. Our financing facility, we just signed on to a financing facility which has already given us 1.5 million as an advance placement, a share subscription, and we can access capital of around 45 million going forward. I mean, that's on the basis of any advance notice that we send out to them. And the way, I'd just like to talk about the strategy here. So the strategy was that we get enough money to take us through the next 1.5 years, which is going to financial close of this big project. So the working capital requirements of our company are met, and we are not continuously then going back to the market constantly to raise money, and we have enough. We also are then in a better position to negotiate with the Chinese, and we are not being held back on account of liquidity issues. And secondly, a part of our strategy is to diversify, as I said earlier, and the access to finance gives us a good position to be able to pursue, look at, and discover and find the right undervalued asset somewhere, given that the valuations are down, either working with another company or becoming a majority shareholder or acquiring another asset. So that's what we are also looking at currently. And so being able to fund that activity is also something that we wanted to put together, and that's what has been achieved through this. And we weighed all the options, and we thought this was the most economical way to actually both solve our current problem and also give us the ability to actually grow into a bigger company and have more than just one project on our platform. Obviously, our investors and all our supporters are really interested in what's really going on now on the ground. I'm not going to go through all of this, but just some sort of highlights that we've gone through. We've got a great feasibility in place, although this feasibility will be enhanced because we started off with a 3.8 million tons per annum, but right now our plan is to develop a 16 million tons per annum mine, so which means this feasibility will require more holes, boring, etc., but we're already there. Our we're sort of on the way to achieve that. Our environmental studies are in place. We've got the sort of for the hydrology and water management, we will need some more work, but the sort of the main building blocks are all there. In terms of the power plant right now, and this is what we are in the process of getting, and that is a letter of commitment, which is typically referred to as an LOI from the government, so that we can proceed. And then after that, we file petitions for tariffs and so on. So if we are able to proceed quite soon, in the next month or so, or 2 months, we are looking then at a financial close, soon after, maybe a year or so, because then after that, we have to quickly go through the process of obtaining all the other permissions. Once the government has allowed you to proceed by issuing this document, then we are also bound time-wise to not delay the process of closing the financing deal, which is with the banks. So then everything after this starts to follow, and but we need money then to ensure that all our technical feasibilities, our grid studies and so on are not delayed on account of cash. And that's where we feel we're very strong right now and we'll have no problems. Just some idea of the resource that we're sitting on and its value and what it really means. And as I said, it's lignite coal, great for thermal power, but also from all the research that has already been done, it's ideally suited for coal to liquid technology and gasification as well. The project partners, CNCDC is a very strategically important player in this project in Pakistan. As I said, it's ex-Ministry of Coal. They have a total production capacity of 300 million tons per year, 60 billion tons of controllable resource reserves. It's a huge company. It's I'm told the third largest company in the world, and I think that's perhaps what their website says. But it's a very, very big company, and they manage the coal projects in China. So that's a big advantage, and the government of Pakistan is also is keen to ensure that their investment materializes sooner than later. The private office of His Highness they are also a shareholder in Oracle, and they're very committed to this project. They're also committed to do other projects with Oracle and grow our portfolio. Some of our consultants and people we've worked with in terms of the milestones, because this is we've been on ground here for a while. A bit of background here, because it has taken a while. I'm based mostly in Karachi in Pakistan, and that's really helped to mobilize things in the last 1.5 years, whilst prior to that the management really sat in London, and that did not allow things to move as fast as they could have or should have. And I think there was a bit of delay on account of that, but that has changed now, and I tend to be here as much as possible. In fact, literally, I feel I can't leave even when I really want to, and I'm even hard-pressed going to London. I barely get to go, because this project really requires my complete attention and presence, and and literally following up on a minute-by-minute basis. It's a very complex project. A lot of stakeholders and a lot of government agencies are involved. By just looking at the sheer size, and also by looking at the sort of the different concessions and the different permissions which are involved in getting or pushing something like this through. So we've got all the feasibilities in place. We've done the environmental assessments. This is 66 square kilometers of land, and on which we'll be digging a mine. There are people, there are villages. So there's a population census. People will be, located elsewhere, and so on. We've got a tariff, a coal price tariff for the feasibility stage, but as soon as we proceed, we'll have to sign a coal supply agreement to actually buy coal from ourselves, and at that stage, we will have to get a contract stage coal price, because the coal price is a pass-through item for the power tariff. So all of this then starts to come together. And then, of course, as you proceed, you get a letter for buying, the government gives you what is called a power purchase agreement, and so on. So that is to follow once the LOI is issued. The government of China and government of Pakistan meet twice a year, and that meeting is called the JCC. So the JCC last that was held was in November 2019. So some of the delays that we have experienced of late is because Chinese haven't been able to travel, Pakistani government has not traveled. So the JCC, which actually confirms projects between the two governments, which is held, as I said, biannually, was supposed to be held in May, June, July, and now probably September, probably October, no date out as yet. And that is also a delay which is holding us back as well. So as soon as the JCC is held, our project, along with a lot of other projects, also get ratified, and then the speed becomes much faster. Because it's CPEC priority, but the meetings have to confirm the commitment of investors, and there's a lot of commitments that both the governments then sign off on. So that's where we're at, and we're really hoping that these meetings take place soon. So then our delays are dealt with. Okay, and so just some structure, because how do we work in Pakistan? We've got two project companies, one for the mine, one for the power, and going forward, we'll be setting up another company for the gas to urea plant as well, and for which we'll probably also join hands with other urea manufacturers. But those are all our deals in the pipeline. Once we can proceed with our power plant, that's when we start to get on to building the blocks for the second phase of the project, which is the gasification project. Some data, the shareholdings, who our board of directors are, so we've got a good team of people, and it's an experienced team, and they sort of are guiding the whole process, and hopefully we are able to very quickly take this out, and we're very concerned, and I'm very focused on being able to deliver the shareholders value for their investments, and also their patience and their support so far. So whilst we are doing this, and whilst there's a promise of a cash flow as soon as we have financial close, I think before that we should be able to deliver returns through a project which has a quicker turnaround and is able to generate cash flow sooner than this project, so that our company is, continues to get support, because it is also giving back as we keep growing. And yeah, that's it. And thank you very much for giving me this opportunity. And I look forward to the questions, and happy to answer them. Thank you.
I'll start the ball rolling. First question, just in terms of what you said there, you're trying to summarize what you said there. You're basically saying that the Thar project is the flagship one, but you are looking to diversify into other projects helped along by His Highness and his sort of expertise, or his knowledge, or his network around the place. You're also saying that it's not all about the LOI as far as the Thar is concerned. It's an ongoing project, and basically the Chinese wouldn't be involved, and the Sheikh wouldn't have taken 15%. if it wasn't going to happen, or if it was going to go on forever. So this is basically something that it's in the can. It's a painful process, because all government processes are painful. But for shareholders entering the fray now, you have a situation where the dirty work's been done, and they're basically waiting in the penalty area for the ball to arrive so they can kick it in the back of the net.
Yes, and I mean, you couldn't have said it better, but it's absolutely there. We're almost there. And I also want to add that the reason it has to happen and will happen is because of the importance of what this means for Pakistan. And so the current situation in Pakistan is such that without this, there will be a lot of security issues, energy security as well as food security. Both are key. I mean, we're a commercial outfit, so we're not here doing philanthropy for any government or anything, but we are aligned with what the government needs. So the government needs CPEC. One, you cannot fund projects in billions of dollars in Pakistan through commercial bank operation. I mean, project financing of this sort or private equity doesn't come into Pakistan to develop coal mines. And without developing this resource, our baseload fuel is now at this point in time all imported. And that is causing a huge problem for the government. There are debt issues. There are, as I said, like we are always in some IMF program or coming out of one and going into another one. So these are big issues here. We are stuck, cash strapped. And secondly, we have food security issues because Pakistan has had a pretty good substantial, for the first time since the kind of the formation of Pakistan, we have now fallen below 50% of the gas reserves that have always been here in Pakistan. So we see declining natural gas reserves. You're already importing LNG, and we're going to have a gas crisis. And our agriculture is entirely dependent on urea, and already our urea manufacturing is shut down. So Pakistan today is looking at the development of coal as a very key strategic play, and that's why we are sitting on something which is inevitable.
But why can't they just say, folks, it's going to happen. We're going to start. We aim to start by the 1st of January 2021. Sorry to put you, sorry to keep you waiting, etc. I mean, is that possible somehow?
Yeah, that's possible. That's possible. In fact, I was in a meeting today, and that's exactly what I asked them to say. I said, you know what, you need to say this, and you also need to tell me you're sorry for making me wait. So, I mean, the thing, it will, but as I said, COVID has also delayed us slightly, well, a lot, and especially these intergovernmental meetings have not been held. So once they are held, a project like ours gets mobilized much sooner, because people are, the government has to sign off on the project viability, meaning the financing specifically, because this is coming under a program of financing. So that has to be signed off in a governmental meeting, and that's what the next JCC hopefully will do.
Right, just a couple of quick questions. First, as far as the current share price is concerned, around about 0.7 pence, would you agree or disagree that it's currently the company's being priced basically as a binary bet, which, as far as from obviously listening to this presentation, it isn't?
Well, right now, I mean, if I announce I've become the Queen of England, they're going to tell me where's the LOI. So that's the problem. And so it seems to me that there is so although there is a big project, we are a rich company because we own a very, very rich asset, but cash flows are sort of dependent on government permissions. And because cash flows are dependent on government permissions, and LOI is just one of them, there are going to be many more after that. So, but because they are, there's a link between expected cash flows and this, the value for everything else seems to have been diluted. And so that's why it's really important for us as a company. So whilst we develop this and sort of build our own stamina to keep going, because this is not a project we can or will or would want to abandon because of how important it is and what it is, how valuable it is, we will try and introduce quicker cash flows so that you know, the support that we have from our investor base is not diluted, and they can continue supporting this big project. At the same time, we are able to give back something in terms of higher value.
Right, and just as you obviously enjoy talking about timeframes, what is the time frame on any other project that you may have in Africa or elsewhere?
Do I enjoy talking about timeframes?
I think
I'm
that
forced
was
to talk about timeframes.
slightly sarcastic, perhaps. But
Right.
Is there a time frame on
the other projects? Well, short term. I mean, short term again. One would argue short term is 1 year, 2 years, perhaps. But obviously, we are not going to jump into anything which is not lucrative, which doesn't make commercial sense. A lot of commercial sense. But I think there are many opportunities out there in the current environment, and a lot of those opportunities are coming our way. And I think that we should be able to, acquire or select something or form a partnership where we are able to have another project along with our key project, so that our platform then is delivering value sooner than the timelines in quotes expected for a huge project like the one we are developing.
Yeah, I mean, I was asking that question on the basis that there might be some people say, like, well, let's forget it talking about the Thar project. I'm not interested. I've had enough of it. I want to just view Oracle as a start from scratch mining development company, and as if it started on the 1st of August, and wanted to see how long it would take for them to find a project and develop one, and just do things in the normal way that we see all over the place, rather than this sort of second coming, which seems to be there with the Thar project. So
right,
just as if Thar wasn't there.
I hear you, but if we get into a project which is quite high on the value chain, we might end up paying a lot for it, or we don't want to pay for it. So we need to find something which is higher in the value chain, close to fruition, but not that high priced. So that's the objective, clearly, to bring on something soon, and which is close to cash flow, but it is priced right for us, and also there's synergy between us and the project.
Okay, well, I was going to finish up by saying I look forward to your return to England, but I think that might be bad to try and get you on a time frame on that as well. So we'll leave that. But it was a pleasure to listen to you today, Naheed, and hopefully we will meet and speak and do this kind of thing again very soon. Thank you very much.
Well, thank you so much. Thank you.
Right, the final part of today's event is a bit of fluff, maybe a bit of light entertainment from me. Just talking about the top. I sort of built it as a top five charts of the day, but actually, rather weirdly, right at the end this afternoon, I decided to add in a sixth chart, because the last time I did this thing. This sort of thing was in a live event, a physical event for a UK investor. I think it was in about March, April last year, in the good old days when we could do what we liked. And so that time, I think 3 of the stocks in the first month tripled, 2 doubled, and 1 stayed the same. So that was a rather successful situation. I don't remember that as being a particularly great time for the stock market, but as Gervais has suggested, sometimes the small caps can be outperformers. But I wanted to look at this chart first, because I think it's actually one, because it begins with A, but the other point is that it was actually coincidentally, and I didn't know that it was Gervais's largest holding, and again by coincidence, it's been one of today's big stock market rises. And the charting situation here is that there was a line of resistance there from June. Shares were sort of in a range between 120, 150, and today you don't have to be a chartist even to know that there's been a nice breakout for the shares. The way I've got it in terms of the price action here, the shares are in a rising trend channel from April, the 2 parallel lines there, and at least while we're above £1.50, the breakout level we could hit up to £2.40, retesting that high from May, perhaps over the next 4 to 6 weeks. That tends to be my favorite time frame for these to happen. So above 150 up to that particular level. The next stock, which I'm going to try and dig out on the charting situation here, is Dukemount Capital, which again is quite a timely situation. I was thinking about doing this before, but basically we had the breakout for the shares last week, with the shares breaking the 0.8 pence level. They sort of danced around a bit, but today we've had a proper move to the upside. Dukemount Capital, if you don't know, is it's a long-dated income company, and so they have investments around the place. You can obviously look it up, EPIC code DKE. But what's interesting here is that the shares are in a rising trend channel that I've drawn from October. Hopefully the shares now above the 0.7 area will head up towards the top of the channel there at 1.4, which they've done two or three times over the past year. So that seems to be a nice charting situation. Difficult to avoid the metals area, so I did want to have one stock which was had exposure to the latest rise in metals prices. I did talk about this in another place a few weeks ago, and the company announced that it had a little bit of a problem with one of its projects, but it's bought a new project in the last week, which is a gold project, and that does look quite healthy. Overall, the shares, not much of a chart here, obviously, but overall the shares in a rising trend channel, based at the 2 pence level. That's obviously the stop loss zone, and above 2 pence. I'm looking for the top of the chart again, and a retest of July resistance towards 5 pence. Probably the time frame on that, the next 1 to 2 months for that particular situation. Stock which has been a decent riser, and I covered a few weeks back in my daily charting video, which I do, which I actually hadn't actually seen the spike here that we've had today, but in fact, you have to believe me that I picked this out before the spike. But basically above the 200-day moving average on Sensign Health, looking for the top of that triangle there, up to £1.10, which obviously we had a good go at today. So I'll have to maybe regroup on that and see if I can find a stock which hasn't actually already flashed up. But as I said, I think that's flashed up right on the day, or just before I was able to give this presentation. Next situation is one which is a bit earlier in the sort of the series in terms of rising. Here we've got a broadening triangle on the safe style chart. We've broken that line of resistance there at around 30 pence, and that's why I've included it today. We had a sort of close just around that level yesterday. Above 30 pence, looking for the top of that triangle there at 55 pence over the next hopefully 4 to 6 weeks at the latest. So a nice recovery for that situation there. But again, the power of the broken trend line, I think, is one that one should look at and absorb. Finishing off with Zoetic, which, if you haven't heard about it, is a cannabis-based products company. They're sort of licensing chewing tobacco and all sorts of other nasties, but in fact that's the current business plan, but in fact they're going into beauty and cosmetics as well. So CBD is or has become somewhat of a new rock and roll. I like this chart because we had the breakout last week. Shares then tested old resistance as new support around 14 pence, and have then rallied again. So looking for 27, 28 pence on this stock over the next month or so, while they remain above 14 pence. So those are my 6 stocks: Avacta, Dukemount, Empire Metals, Sensign Health, Safe Style, and Zoetic. Those are the 6 top tips on a technical basis. We'll just try and come back to, see if I can come back to me. I don't know if I can actually at the moment. Stop the screen share now. And just really basically say thank you to Gervais Williams from Premier Miton. Thank you to Oisín Fanning from Sanley on Energy. And thank you to Naheed Memon from Oracle Power, who I feel I gave her a hard time, but maybe I'm sure she's used to it. And so basically, I hope you enjoyed today's presentation. I presume that there'll be a recording of this available pretty soon. You can sort of go through the three presentations that we've had. Maybe you can ignore my one because that was the less serious part. But definitely three decent things to watch today. And hopefully we'll see you again soon at the same venue here at the UK Investor Webinar. Thank you very much.
Thank you very much.